Hi, I'm Jason Williscroft. I'm a former naval officer, U.S. Naval Academy class of 1995, and I'm the founder of RINGKNOCKER. RINGKNOCKER is a group of current and former military officers that have come together for networking, shared opportunities, and mutual fire support. So there's this sitting around in a circle talking thing we do aboard ship in the wardroom after evening chow when we're too late to hit the rack and too caffeinated to sleep anyway, but too early to relieve the watch and too tired to do any actual work. That's called a bull session. And frankly, it's where a lot of a military officer's really practical learning happens. A few weeks ago, a couple of us ring knockers thought we'd pick a topic and try doing that on camera. It worked out okay, so we did it again. Now, this is RINGKNOCKER Bull Session number 3, and our topic is fragility, robustness, and anti-fragility, the science of thriving no matter what. The participants in this conversation are all military officers and in some cases now business leaders with decades of experience making high-stakes decisions in the face of massive uncertainty. We are largely not formally trained in the theory of risk management. Instead, we have a bunch of actual experience managing actual risk, often with actual lives and fortunes on the line. Today's discussion focuses on fragility and anti-fragility, twin concepts formalized by trader Nassim Nicholas Taleb in his influential Inserto series. This is the work that popularized the term black swan, a so-called highly unlikely, catastrophic event. The coronavirus pandemic is a black swan, an event that injects extreme volatility into just about everything. Now, volatility is a product of randomness. Sometimes there's a little, sometimes there's a lot, and sometimes there's so much that the whole world blows up. Fragile things are negatively affected by extreme volatility. Examples: crystal vases, fancy restaurants, central banks, short options. Robust things are neutrally affected by extreme volatility. Examples: combat boots, grocery stores, government contractors, treasury bonds. The anti-fragile is positively affected by extreme volatility. Muscle, character, pizza delivery services, long options. All these things thrive on hardship. Today, we deconstructed anti-fragility and examined how that concept can be deployed into a decision-making framework that reliably converts disaster into opportunity. This was a great conversation, and we're excited about exploring the format more deeply, which we will do next time. Go to ringknocker.net/bull to see the lineup of upcoming sessions and recordings of previous ones. But for now, please enjoy RINGKNOCKER Bull Session number 3 on fragility, robustness, and anti-fragility, the science of thriving no matter what. Cassandra Koistinen.
Hey, what's up? I'm eating dinner,
How are you?
Good. So I'll keep the camera off until I'm done eating.
That's just fine. I'll hang out with your dog. You're the only other person. Oh, here comes Jim McMullen. How about that? We got, and then there were 3. Hey, Jim.
Hey, how's it going, Jason?
Have you got a green screen over there?
No. This is a feature in Zoom, but I've just got the wrong background. I'm trying to figure out how to fix it.
Looks good. All right. Right here. What's going on here? Sorry, hang on. I got a little alarm going off here. There we go. I had my iPad was telling me, hey, there's this meeting starting, you know, this RINGKNOCKER thing. Cool. All right. Well, I'm expecting 1 or 2 other people. So why don't we give them a couple of minutes to show. Jim, have you met Cassandra? I don't know if you guys met on the last. You can't see her. I think she's having dinner while we're talking.
Yeah, I think I did. I saw her name last time. I may have heard her introduction.
Cassandra, you want to? Can you take a moment and introduce yourself?
Yeah. So Cassandra Koistinen. I'm a Naval Academy 02 grad, NAPS 98. Active duty, retiring next year. Working cyber mission. I'm a cryptologist. I was a SWO, but I jumped ship, so been doing that for the last probably 15 years, cryptology. So
you never get tired of saying that, do you?
Yeah. Thank you very much. Yeah, I remember you from the last meeting. Thanks, Cassandra. I'm Jim McMullen, Naval Academy 95, sub guy, then FAO, retiring someday. soon, hopefully. We'll see.
Yeah, you got it. You're definitely in the window, right?
Yeah, but I mean, I'm in Honolulu. I'm teaching school, so I don't have any complaints right now.
Just keep accepting orders.
Yeah.
Well, you got actually. It's ironic because this feeds directly into what we're going to be talking about tonight. You know, this topic of optionality, which tell me, Jim or Cassandra, have either of you here? Give me a sec here. I'm going to share a piece of my screen. You can probably see that book cover there. Have either of you ever read this one or any of the others by Nassim Nicholas Taleb? Fooled by Randomness, Black Swan, Bed of Procrustes, Anti-Fragile, or Skin in the Game?
No, I have not.
How about you, Cassandra?
Yeah, Skin in the Game I've read. I haven't read The Black Swan yet.
Okay.
Yeah.
So this is basically the basis of the conversation tonight, and these books kind of, you can call them a series. What they really are is sort of a protracted argument, right? So let's see. Why don't let's back up. I don't want to get directly into that right now. I guess we've been through the intros. Let's real quick for posterity's sake. Let me give a quick intro to exactly what it is that we're doing here tonight. This is a RINGKNOCKER Bull Session. The two of you obviously know what RINGKNOCKER is, and actually I think you've both been to a bull session before. But basically this is different from a meetup. A meetup is a whole bunch of people getting on screen and sharing needs and opportunities and all that. This is more of a directed conversation, and the key difference between the meetups and the bull sessions is that the bull sessions go more or less straight to YouTube. So just an FYI for both you guys and anybody else who's showing up while I can't see the list of people. These are going to go to YouTube with some light edits, but don't shut out your social security number, right? And now let me stop this share because I'm not actually showing anything. There we go. So, and we got a new fella, Paul Samet. Paul, can you hear us?
Yeah, I just finally got the settings right, I guess.
Are you new to Zoom? It can be a challenge if you are.
I use Zoom quite a bit, but it's usually already set up and
oh, fair enough.
More buttons than I was expecting.
Oh, there you go. And now we got Mike too. Well, Paul, we're just getting started. You want to give us a brief intro and take a minute and tell us about yourself?
Sure. Paul Samet, I was a class of 97. I was mostly on the West Coast, pilot P3s, and then last duty station was in Magoo with VX30 or whatever, doing test and evaluation, and then got out and started up a private jet company on the East Coast with another Academy guy, or actually a couple of them. And we sold that one a couple years ago, and then now we're in air-to-ground technologies, another company.
Sounds like fun.
So,
well, welcome to the call. I may repeat myself a couple of times for the folks who were on a moment ago, just so we can make sure we all get this. So, unlike the regular meetups, this is a bull session. This is more of a directed conversation, and we can expect this call to go more or less straight to YouTube. We'll do some light edits, but this is, consider this as a public conversation, right? So don't go shouting out your social security number or anything like that. And we'll do our best to make it interesting. Mike Foster, I see your name on the screen. Can you hear us, sir? All right, we'll let Mike get his tech all set up. All right. Well, anyway, so we were just sort of digging into the conversation, and what I was saying is that what we're doing here is looking at a set of ideas that come from a series of books written by a fellow named Nassim Nicholas Taleb. that began in 2001 with Fooled by Randomness and went on to The Black Swan, and more recently Anti-Fragile and Skin in the Game, right? So let's talk for a moment about Taleb. And here, let me throw a, I'm dealing with some buttonology myself, so bear with me for a moment. I'm going to throw a book cover up on the screen. There. So there's The Black Swan, and there's a bunch more like that. So real quick intro to Taleb, since he's the central figure here. So Taleb is a trader. He made a significant fortune during the '87 market crash, and we're talking somewhere between high 8 and low 9 figures. Basically by employing the ideas that he wound up developing in the Inserto series, which is this series of 4 or 5 books, depending on how you count. He's also a kind of a semi-professional mathematician. So what you're going to find is that most of his popular work, which are these books, are backed up by some pretty rigorous stuff in sort of peer-reviewed journals, and frankly his own skin in the game. And this is a topic that sort of comes up often in this work and in discussions around this work, that contact with reality is the ultimate arbiter, right? And there's really no substitute for it. Also describes himself as a bit of a tourist and a slow walker. Right. So of the new guys, has anybody dug into this stuff before? Paul, have you seen this material before?
Yes, read this book.
Right on. Okay, so not entirely new concepts, and this is this is stuff that we've especially in the Navy, we all know this, even if we don't know it formally. So I don't think any of these are going to be new ideas, but hopefully sort of pulled together in a way that will generate some interest. And if you wind up reading through part of the series, then mission accomplished. Okay, so with that said, let's set our discussion by talking about 2 countries that Taleb references sort of throughout his series. So these are 2 imaginary countries, right? One is Mediocristan. So Mediocristan is a place that is governed by rules, right? Where random events proceed according to some sort of a knowable probability distribution, right? So think coin flipping or dice rolling or blackjack in a casino, right? Situations where the odds are knowable and can be calculated, and where you might not know what's going to happen in the future, but you can at least have a pretty good idea of how often the things that are going to happen are actually going to happen, right? So that's Mediocristan. Then there's Extremistan, right? So Extremistan is a very different country. On the surface, looks like Mediocristan. In other words, things that happen tend to happen in what look like predictable ways, but the dynamics in Extremistan are actually governed by extreme events. In other words, most of the gains or losses that you actually have in Extremistan, most of the damage that you suffer, most of the profits that you make are irrelevant because they're small compared to what happens when singular unpredictable events happen. The black swans, right? The hurricane or the tornado that runs through your backyard, that kind of thing, right? So in those cases, what happened, and think banking crises, right? Where a bank over the course of a day can lose all the profits they made in a century. So that's Extremistan. And one of the things that we're going to sort of dig into as we proceed in this conversation is that in most of the real world, in other words, most of the world outside of casinos, most of the real world actually is Extremistan, right? And so many of the rules that we come up with to organize our activities in Mediocristan just don't really necessarily apply, right? So let's talk turkey. I want to introduce you to Tom, the Thanksgiving turkey, right? So Tom, he's got a lot of time on his hands, right? He's been around for a while. You know, life has had some ups and downs, and Tom is a numerical sort of a beast, and he likes to sort of track how things go. So he's got an index that he uses to track his own well-being. And Tom's been around for a couple of years. He's approaching the prime of his life, and there have been ups and downs. You know, a thing with the barnyard dog, but lately the turkey feed has been especially good, you know, life is good, right? So Tom is looking at his long and his short-term averages, and they all line up. Everything looks good. The ladies are nice to him, and there's absolutely no reason to believe that the next 1,000 days won't be just as good as his first 1,000 days. But, you know, there's a surprise. And what Tom learns in a very abrupt manner is that he's actually living in Mediocrestan, or at least he thinks he is, right? Tom believes that the future is predictable and that past performance is an indicator of what things are going to look like in the future. But Tom is actually living in Extremistan. In other words, his experience, his direct experience, is governed by very infrequent, very extreme events. And Tom believes that he can predict the future because he thinks he's got a pretty good idea of what the underlying dynamics of his life are, right? So, you know, he runs away from the barnyard dog, the turkey feed shows up on time, and, you know, occasionally he might catch the turkey flu, but otherwise things are pretty good. And of course, the farmer knows something that Tom doesn't, right? So there's this notion of, let's call it information asymmetry. What's random to Tom is not at all random to the farmer, right? But to Tom, that doesn't matter. So, so Tom's experience now is an Extremistan experience, right? So now I want to let me stop my share for a second. Let's talk about that. So, Jim, can you tell me about a time when you've been Tom the turkey?
Yeah, absolutely. I can. I would characterize the most recent thing with the pandemic that's happened. Some choices I made with respect to the stock market during the pandemic. You know, I thought the market was going to continue to go down, and so I withdrew some assets. Turns out I was wrong. You know, so yeah, I think that would be one situation.
That's fair. Yeah, and you know, we're going to talk a lot about markets here, and I guess you know, we all have our own experience, right? So a great deal of my experience is in markets, and so for me, markets are a convenient metaphor, and it's also one that's, you know, that Taleb uses a lot in his work. But you know, I look at Tom, right? So we can represent Tom's experience by a graph on a chart, but you know, the reality of his experience is much less. It's more qualitative than quantitative, right? And one of the interesting aspects of the Extremistan experience versus the Mediocrestan experience is that you can handle it qualitatively, right? There's enough of a distinction between the black swan event and the shall we say the everyday event that you really don't need a very finely graded ruler in order to tell the difference between those two. They are immediately and starkly apparent, unfortunately, only after the fact. Paul, you want to chip in? Have you had your Tom Turkey moments recently?
Yeah, I don't think I could be in a worse industry right now.
Amen, brother.
So it's just seeing everybody stop flying almost overnight. I was fortunate to have gotten out of the business jet business because from what I heard, you know, some of that business stopped to 90% overnight. It dropped. Yeah. And so, but it's been slowly ticking back up, and same thing with the airlines. I don't know when they'll recover, and they've lost so much money. I don't know when they'll have money to invest again. So. Yeah,
I hear you. If you join us at a meetup sometime, you're gonna meet not an insignificant number of guys who either recently were airline pilots or, were on their way out of the service and had offers from, from airlines, and, all those guys are sucking wind right now. So, yeah, definitely you guys took it in the shorts. All right, here, let's, forgive me as I'm going to fumble occasionally on this stuff because I got a small screen and a lot of stuff going on it. So just bear with me for a second here. So, all right. So let's talk about a non fairy tale version of Tom the Turkey. Let's see. Let me get back to this sharing the screen thing. There we go. Okay. There we go. Okay. So now this goes back a couple of years, but I'm sure at least the older guys on the call remember this. Long-term capital management. This is a classic case, right? So long-term capital management was a hedge fund that was founded in 1994, and it was founded by a number of folks, but on the board were Myron Scholes and Robert Merton, who in 1997 won it's not really a Nobel Prize, but the quote unquote, the Nobel Memorial Prize in economics for inventing the Black-Scholes method of pricing derivatives. So Black-Scholes is how everybody does it everywhere all the time these days. It's you jump on E-Trade and want to see what the theoretical price of your option is, and they're using Black-Scholes, right? So they invented Black-Scholes, and of course long-term was sort of fundamentally an options play, right? So that seemed like pretty good insurance to have those guys on the board, right? They're the guys who invented the method that long-term capital management was using, and they won something named after a Nobel Prize for it. So long-term did pretty well, right? So the first year that they were in, and they had, by the way, they had about, I want to say about $4 billion, somewhere between $4 and $5 billion under management. So year one, they made a 21% return for their investors. In year two, they made a 43% return for their investors, which is, I mean, if you're in markets at all, you can, that's astonishing, right? Year three, a 41% return on their investment. And at the same time, the Dow was probably up maybe 10% at that point, right? In year four, over a period of 4 months, long-term capital management lost $4.6 billion, basically its entire equity. At that point, they were leveraged 25 to 1, meaning every dollar that their portfolios lost, they lost $25, right? So at the end of the day, they were kind of lucky just to lose their entire investment instead of a large multiple of their entire investment. The screen that I'm sharing there shows the long-term capital management chart compared to that's the blue, compared to the Dow, which is the red, and then for reference, a U.S. Treasury in orange. What would have happened if I'd invested $1,000 in each one of those at the beginning of the period, and if I compare that to this, it ain't all that different, right? So things that look the same often have something similar going on, right? So I want to unpack this a little bit. So the founder of long-term capital management was a guy named John Merriweather, and in interviews after the fact, he referred to the circumstances that produced this loss as a 10 sigma event, right? So 10 sigma, that means, we're looking at a normal distribution, and this is 10 sigmas, 10 standard deviations beyond the mean. What he's saying is it's a highly unlikely event. In fact, an actual 10 sigma event is extremely unlikely to occur even once in the lifetime of the universe thus far, right? Much less the fourth operating year of a hedge fund. So maybe a bit of an exaggeration on Merriweather's part, but it's informative, right? because the one thing that Merriweather let slip when he called it a 10 sigma event was this assumption that he clearly held that that the events that were occurring were part of some knowable probability distribution, right? Now, when you think about it, a highly unlikely event, if you're measuring the occurrences of events and asking yourself, well, you know, how often did this happen in the past and how often is it likely to happen in the future? You know, if you're talking about rolling sixes with a pair of dice, that's one thing. You can do that 1,000, 10,000, 10 billion times in simulation, right? But if you're talking about a black swan event that's only ever happened once, it's kind of hard to look at that and say, well, it was likely or unlikely because, you know, it only happened once, right? And so the fundamental error that long-term capital management made was that they were living an extremistan, but they were investing like they weren't, right? So in other words, the Black-Scholes model fundamentally assumes that there are, I won't say necessarily normal distributions, although it does, but that there are knowable probability distributions that govern the dynamics of events. And it doesn't, nor could you really expect it to, make any effort to take into account the incidence of the unknown, right? And so the real problem happened when you had people trading billions of dollars as if they could know that something like what happened wasn't going to happen. And then, of course, everybody got really surprised when it actually did, right? So that's interesting, right? Because how often do you get to relate the experience of a barnyard turkey to the experience of a $5 billion hedge fund? And at the end of the day, interesting that the dynamics are very much the same. In other words, in each case, there's an underlying dynamic, an underlying real world that the farmer knows about, but the turkey doesn't, right? That the turkey is simply not taking into account in his calculations. So again, I want to stop the share for a second. And hey, Ron Poe's here. Ron, you've been with us for a couple of minutes. Have you caught the long-term capital management bit?
Yeah, just a few minutes, and I remember doing a case study on that years ago, but I'm a little rusty on it. But it's quite a story,
right? And certain assumptions were made, right?
Yeah, I think I missed part of this. Was this the one where their model was anytime they lose, they double down? Well, so this was long-term capital management. It was Scholes and what's his name? The guys from the Black-Scholes model were on the board. They were leveraged 25 to 1. They made 20-odd%, and then 40%, and then 40%, and then the next year they lost $5 billion, right? And there was the one where the founder, like they kept, as everything kept going down, they kept betting more further down because they were committed to their model. But the problem was that model was built on the idea that it will come back up. Right. Exactly. They had a runway before they could get the plane off the ground again or something like this.
Exactly. And in this case, there wasn't going to be enough runway in the whole world leveraged 25 to 1 to, what we were just discussing was this notion that fundamentally they were operating under the assumption, the implicit assumption that they were living in an environment where what they called 10 sigma events, right, extreme events, weren't really going to happen because obviously they're very unlikely, when in fact they did. And in fact they do, right? Cassandra, can you what about you? Have you wound up in a scenario where your expectations reality differed significantly and you wound up taking it in the shorts as a consequence?
Well, yeah, actually, that's why I'm retiring. I 2-time FAS. I didn't see it coming. Actually, now I'm 3 or whatever time FAS, whatever. But everything leading up to then had me on the right track. I did everything I was supposed to do. I checked all the milestones, checked all the boxes. I took all the jobs I was supposed to. I got my master's degree. When I talked to the senior detailer, when it came up for the 05 board the first time, everything was looking good. We were penciling in for, my next, once I selected my 05 billet. And so first time around, not selected, surprised, a lot of surprise by a lot of senior officers that I know. So I, obviously I knew I had a second chance going in, and everything looked good going into my next fit rep that would be at the board. And at least I thought I did. Before I went into to get my debrief, and found out that my senior officer just didn't feel that after you fought the first time, he didn't feel you get a second chance. So I was immediately, put down as the fodder for everybody else. And that was, I was in a milestone bill at the time, so that pretty much killed me. So huge surprise to me. I thought for easy, I'd put on 05 and, do at least 20, maybe more depending, but now I'm an 04 retiring in a year here. And so that was a lot sooner than I expected. Financially, it's a huge blow too, when I was thinking about what I was going to retire with potentially. So yeah, definitely feel that Tom the Turkey there for sure.
Yeah. And that's an interesting point. And again, we're going to be talking about optionality here in a little bit. And so, I hadn't really considered this in the context of a Navy career path, but it's a path, right? It goes certain places and not others, and once you're on it, you're sort of on it. So this lack of optionality, and we'll get into the sort of a more formal definition of optionality in a bit, but this lack of optionality, this lack of having choices once your feet are on that path, really puts you in what we're going to discover is a fragile situation, meaning that when things change, you're often stuck. But my dad had a similar circumstance. He was a Poseidon missile officer back in the day on the boomers, and back then there were two sort of parallel officer career paths, right? You were either a nuclear reactor officer or you were a missile officer. And then Rickover showed up and decreed that every submarine officer had to be reactor qualified. And all of a sudden, half the existing sub officers had their career path jerked out from under them because they weren't reactor qualified. When they went back and got reactor qualified, they were competing with officers that were quite a few years younger than them. So yeah, that's definitely a thing and a great example. Thanks for mentioning that. Paul, you want to chime in? What do you think? Does this ring personally true for you as well? It sounds like it might.
Yeah, I'd say it does. I mean, I don't know if I've had exactly that story up to this point, but it could be there very soon. So. Just depends.
Well, I'm thinking specifically about about the aircraft plays, right? I mean, it seems to me that you don't get into sort of high, and I'm missing a word here, but the sorts of investments that take a lot of time and money in order to bring to fruition. You don't get into those sorts of things without making certain assumptions about the future, right? And those assumptions are to some degree going to be based on unknowable things. And, when the unknowable happens, bang, right?
Yep.
Yeah. Okay. So let's step forward a little bit. So in both of these cases, the Turkey Tom case and the long-term capital management case, we talked about this notion of underlying dynamics, right? So this idea that what's actually going on is often very different from what we think is going on, especially if all we have, and this is almost always true, all we really have to look at is the data, right? So for example, if you're in the markets and you're a technical investor, and what have you got to go on? You've got the prior price history of some security, the graph, right? And that graph may not tell you that the chairman of the board just got nailed with the secretary, right? That may not be in the graph. And by the time it's priced into that graph, it may be too late for you, right? So there are underlying dynamics in every circumstance that are just hidden. And this is true no matter how much we know. Life is fractal, right? So at every level of detail, there's more detail. So here's a thought experiment. I'm gonna hand a nickel to each of 1,000 monkeys, and I'm gonna ask each of those 1,000 monkeys to flip that coin, right? So at the end of those 1,000 trials, it is pretty likely, about 50% likelihood, that one of those monkeys will have flipped 10 heads in a row, right? It's highly likely to happen. So these days, what would happen then is that the monkey will hang out his shingle and he'll launch a webinar and he's going to become a coin flipping consultant, right? He's going to, he might never flip 10 heads again, but he's going to, spend the rest of his life teaching other people about, what he had for breakfast that day and how it figured into how he was able to, to flip those 10 heads in a row, right? So that's a career. But here's an even better career. Let's say I got 1 million monkeys, right? So that means I've got 1,000 coin flipping consultants. I've got 1,000 monkeys out there who are convinced of their ability to eat just the right banana for breakfast and flip 10 heads in a row. Well, guess what? One of those 1,000 consultants, he's going to do it twice, right? And that monkey's going to wind up on Fox News, right? So the point here is that it can be often really easy to mistake total randomness for something, right? Easy to mistake something or nothing for something. We do it all the time, and you can go online and just search cognitive bias online or logical fallacy, and you'll find a whole list of them. So one of those is the survivorship bias, right? Where we tend to focus on things that succeed instead of things that don't. So here's an analog to the monkey coin flipping scenario, right? I got a bunch of mutual funds. So in the United States right now, there are about 10,000 mutual funds, right? So in other words, 10 times as many monkeys as we had at the beginning. And so by one theory, you have professional portfolio managers that are very, very good at timing the market, and they're very good at understanding what's going to happen next, and they're very, very effective at choosing, just the right combination of assets to buy and sell in order to maximize the performance and blah, 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 right? Okay. Or they're monkeys. And so what we actually see is, sure enough, every year, there's a set of mutual funds that do very well, right? And they provide outsized returns and they outperform the market, and it's excellent. And you can find them on any number of websites, and where the performance, last year's mutual fund performance is sorted and whatnot. And you can choose your mutual fund and buy in. And more often than not, what you're going to find is that next year they don't do so well. In fact, you're going to find that almost every time, right? Except for that 1 in 1,000 case where the monkey flips 10 heads 10 times or twice in a row, and they actually do better. But the vast majority of mutual funds that have done extremely well last year, this year are going to revert to the mean. So the illustration here is that the pattern that we thought we saw, this is a really high performing mutual fund, is really nothing but random noise. It just happens to be in a sea of random noise. It happens to be the most attractive random noise. It rose to the top and we noticed it, right? There's another analog to this that is a little whimsical, but is nonetheless true. We see faces in clouds, right? But they're not really there, obviously. There are no faces in clouds. Our brains are pattern recognition engines. And so we are primed to see things that look like things we recognize, even when they're not really there. And that can drive our decision making. For example, in the case of choosing mutual funds, despite the fact that the prospectus says past performance is no indicator of future performance, that's exactly what we do. So let me pause here. Let's see. Jim, are you still with us?
Yep, right here.
Jim, tell me about a time when you got lucky and thought it made you an expert.
Too many times. Once again, recently, it goes back to the stock market. There's a stock that was, it's called Clinuvel, and essentially what it is, it's a way to basically tan yourself from within. It's to treat vertigo, but it tans you. So
that sounds dangerous.
Yeah. Well, I bought it, and like we did I think it was like $1 a share, and it went up to something like 27 or something like that. And I thought, wow, this is just going to keep going up and stuff. But it's much like your experience. Just because you got lucky once doesn't make you an expert. So yeah, I don't think my stock picking skills are really that great. It just so happened that my wife got really enthused about that one stock. I'm like, oh yeah, let's buy some.
I'm more.
Yeah, so it's exactly the pattern you think about. Like, we think we're experts, but by no means are we, because we've had the extreme on the other end of investments as well. Whereas if we had gone with kind of what you're suggesting with the mean, just recognize the mean, maybe like in this case, indexing is probably the best way to go.
Well, it can be. So, I think that there are a couple of things to poke at here, right? One is the critical difference between making an evaluation before the fact and making an evaluation after the fact. So for example, if I look at a mutual fund and I say, I think in the next year, this mutual fund is going to do very well. And I put some money in it, and at the end of the year, I made money, that says something, right? On the other hand, if I look at last year's mutual funds and I go, hey, look, that one on top made a lot of money. Well, I didn't really have any skin in the game making that decision. And it doesn't cost me anything to be right, and it doesn't cost me anything to be wrong. And there's no way for me to distinguish my observation from basically survivorship bias. On the front side, I've got flipping coins, if you will, throwing dice. Maybe I've got a 1 in 100 chance of randomly selecting a mutual fund that's going to be profitable next year. So if I manage to select one that is, well, okay, that probably says something. It's at least more likely to say something about my ability to select, because the odds were low that I was going to do that randomly. On the other hand, after the fact, my ability to recognize a mutual fund that did well last year approaches 100%. There's a list right there. I can sort it, right? Somebody's going to beat the market. It's just a question of who, right? Somebody's going to beat the market twice. That's going to happen, or 3 times. There are lots of mutual funds. They're all going to do it. Well, not all, but somebody's going to do it eventually. We haven't heard from, in fact, we lost him. So I guess we're not going to hear from him, our Mike. Okay. All right. So conclusions. What can we draw from the faces in clouds observation, this underlying dynamic thing? Well, there are events that happen all the time, right? So I can I can look at how often I roll 7s when I roll dice, and those are events that are governed by simple probability distributions. They obey, they obey normal distributions or some transformation of those. They live in Mediocristan, and I can say with a high degree of confidence that that the most likely outcome when I roll a couple of dice is going to be a 7, and I'm going to be right about that, right? So those are well-behaved events, and they happen. They just don't happen in many places. In the real world, what we find is that the events that really matter, right? Not the events that make you $1, but the events that make you $10 million or that lose you $10 million, those events don't happen very often, right? In fact, many of them are intrinsically unique. They only happen once, and you have to look at categories of those things in order to look at more than one at a time. So they don't happen very often, and since they don't happen very often, it's really hard to say just what the probability of those things happening is, right? Because there are really two different ways to think about probability, right? I can calculate probability, like with dice. I know a normal distribution. I have a theoretical view of that distribution. I know what the outcome should be in probability space, and so I can calculate what to expect, and I can place bets on that, and then I have a casino, right? So that is the calculation of probability in some theoretical space, and what that requires is that the theory line up with the reality. In other words, it requires that you actually know what the underlying dynamics are, right? There's another way to measure probability, and that's post hoc, after the fact, by actually counting what happened. And the difference between measuring it after the fact and calculating it before the fact is basically the difference between living in Mediocristan and Extremistan. In Mediocristan, even infrequent events, let me start over. When you live in Extremistan, everything looks like Mediocristan, right? Before the black swan event happens, the probability distributions that you're measuring look just like they do everywhere else. It's sevens, it's sevens more often than not, right? You never know that somebody threw you a loaded die until after the fact, until after the black swan happens. And then you can look at it and go, oh, wow, something happened, something changed. And that's the moment that you realize that you live in Extremistan instead of in Mediocristan, right? So that's interesting, right? We never know. We never know until the really bad thing or the really good thing happens, what might happen or when it might happen. So if we don't know, that can change the way that we make decisions, right? So let's poke at that a little bit. In order to do that, we need to talk about volatility. So let me throw another chart on the screen here. Give me a sec. And boom. Okay. All right. So what you're looking at is an example of two different kinds of volatility. Volatility is a measure of randomness. Okay. So here you're looking at two signals, call them what you want. It's labeled stock price here, but it can be the price of tea in China. It can be the weights of dogs in the street, whatever. These are two signals that have the same average value, right? But they've got very different volatilities, meaning they vary a lot more around that mean, right? So if you think about it, that could be a totally different experience, right? So for one thing, if that's what your investment looks like, and if you happen to be leveraged at all, meaning that what you make or lose is some multiple of what you have invested, then when the blue line hits the bottom, you may be tapped out. You may be out of the market. You may be out of the pool, right? Whereas, with the lower volatility, you might still be holding on to your position and watching Fox News. So the experience that we have is generally far more tied to the changes in what we're doing that affect what we're doing rather than to the thing itself. So it's useful to point at the difference between volatility and probability, right? So when I think about probability, what I'm thinking about is, what do I expect to happen? I'm calculating probability, as we mentioned before, and I'm doing so on the basis of some underlying model, some guess as to what I think the dynamics of the thing are, right? In other words, calculating probability is a consequence of having some theory about the world, right? Volatility, on the other hand, is a consequence of measurement. I look into the past and I see what happened, and then I can say, oh, wow, that jumped around a lot, or, oh, that was pretty stable, right? So, so two very different things. Now, volatility happens everywhere. It happens in Mediocristan and it happens in Extremistan. It's a fact of life. It's noise in the signal, right? Everywhere we go, prices go up and down. Traffic is heavy or light. things smell good or they smell bad. That's the nature of the world. The only way that you can tell whether or not you're in extremistan is when volatility and probability diverge, right? In other words, I'm expecting that the demise of long-term capital management will never happen in this way because that's a 10 sigma event. Yet the 10 sigma event happened this year. So what's more likely? That that something that should probably never happen in the history of the universe just happened, or that maybe my expectations are off, right? So bottom line is that in mediocristan, volatility is well behaved. I may not know what's going to happen in the future, but I've got a pretty good sense of what might happen in the future, and I can create a probability distribution like this, and I can expect events more or less to stick to the probability distribution. And again, this doesn't happen in many places, right? Truly well-behaved volatility basically happens in casinos and horse races and things of that nature. In other words, places where mathematics governs, right? But when we deal with the real world, we tend to see something more like this, right? Where I may have a volatility that is so small that compared to what I see when something horrible happens, it's not even visible. And then coronavirus hits and everything falls apart, right? So that's a completely different sort of a thing and requires a bit of a different approach. So again, let's pause here. Hang on. Okay, so Cassandra, what I'm looking for, and let's see if we can come up with this. If you can't, I certainly can. What I'm looking for here is a story of expectation, right? You had an expectation that certain things were likely or unlikely, and it turned out that the thing that actually happened was the thing that you expected to be completely unlikely, totally outside of probability, yet boom, there it is. Now what? Ring a bell? Tell me.
Yeah. Yep.
Tell me the story.
Oh, well, I guess, well, as we were prepared, actually just recent, as we were preparing to go back to work and everything, I expected that I was going to go back to work. We're going to do a week on, week off. And then I got a call, earlier this week or no, last week, that I've been assigned to an IA for the next 6 months, starting on Monday. So yeah, that was not even in the wheelhouse of like expectations of like what's going to happen, where am I going to go next? So yeah, I get to do that. Luckily it's local. I don't have to like leave anywhere. I mean, but not even on my radar of like, okay, I've got 6 months left until I, probably go on terminal leave. I got all this stuff I got to do. And then they're like, oh yeah, by the way, you're going to go support this mission the next 6 months, Monday through Friday. And I'm like, oh, okay.
Surprise deployment.
Gear.
Yeah, boy, does that ever ring a bell? I remember about 1 million years ago, I was supposed to take USS Independence from Japan to Everett and Bremerton and decommission her. And I think 3 weeks before we were supposed to leave, Saddam Hussein kicked all the weapons inspectors out of Iraq, and we wound up doing a flash deployment to the Persian Gulf, and we were there for 9 months on the ship that we were supposed to decommission. So yeah, that's definitely the sort of thing that can happen, and a great example, right? Where we make certain arrangements in our life based on what we think is likely or not likely to happen, and that those require a certain commitment, a certain investment, right? We put our money because we have to where our mouths are, and then often we find, well, more often than should be, it seems, we find that the things that actually happen are things that we would have expected to be outliers, right? Things that we would have expected to be low probability events, yet they keep showing up, right? And so a real point here is that when that happens, it's not a problem with the world, right? The world is the world is the world. It's going to do what it does. What it is a mismatch between our expectations and what actually happens. And obviously, as we gain experience in the world, one of the things that, an advantage of old guys over young guys is that we can calibrate our expectations based on reality, right? And often what that means is that we make more allowances for unexpected events. But there always seems to be some level of event that still happens even though it was way beyond our expectations. So that's a thing, right? That is, again, with the fractal nature of things, right? Like no matter how well you prepare, Murphy's Law, no matter how well you prepare, there's always something that seems to happen that's beyond your preparations, right? Okay, so this is, oops, I think I just lost my thing. This is an interesting place to go, right? Because how do you make decisions when not only do you not know what's going to happen, but when you can't know what's going to happen? Okay, so this gets us kind of into the central idea of this chat. Let me share my screen again here. This notion of fragility, resilience, and robustness. So let's take this in pieces. When bad stuff happens, a reasonable expectation is that you're gonna get knocked out, right? I mean, that's the typical experience when lots of really unpredictable stuff happens. Think about a crystal vase, right? What kind of environment does a crystal vase like? It likes things quiet, right? You take a crystal vase and you put it in a moving truck without packing it up or anything, bump it around on a road, and when you're done, you're going to wind up with a bunch of crystal shards, right? So a crystal vase is fragile, and a formal way to define the fragility of a crystal vase is that it has a negative response to volatility. In other words, when the conditions of a crystal vase change unexpectedly, it is not likely to improve the condition of the crystal vase, right? So a crystal vase is intrinsically fragile. There are other things that are intrinsically fragile, right? So there's this myth of the sword of Damocles, right? So this was this guy whose punishment was to have a sword suspended above his head by a single hair. A breath of air in the room and that guy's dead, right? Other examples of fragile positions. How about if you sell insurance in a hurricane zone, right? So, an insurance company is collecting premiums, and over, a period of time, it's going to make what seems to be a predictable amount of money until 3 hurricanes hit in the same season, and all of a sudden, the insurance company loses all the profits they've made for the last century, right? That's a fragile position. Then there's resilience. So resilience is sort of it's the edge of the coin, right? It's a kind of position that is sort of insulated against change, against volatility. When things get bad, it's okay. When things are good, it's okay. So my favorite example of resilience is combat boots, right? Like there's very little you can do with a pair of combat boots that's gonna destroy them. By the same token, there's very little you can do to a pair of combat boots that's going to make them not be combat boots, right? So they are, they kind of are what they are no matter what happens to them. And really that's why we like them, right? I mean, we want to put something on our feet that are kind of going to stay the same even when stuff around them doesn't, right? So a resilient position is an edge case between two sort of different domains, but it's indifferent to volatility or tranquility, right? It just sort of doesn't care. And then there's the anti-fragile position, and this is where we're heading today, right? So the anti-fragile position is the exact opposite, the polar opposite of the fragile position. So let's unpack what that means. If a fragile position is worsened by volatility, in other words, when things go random, the position gets worse, and think again insurance, right? When 3 hurricanes come at once, the insurance company is going to lose a lot of money, right? The anti-fragile position is the exact opposite. So in an anti-fragile position, the worse things get, the better off you are, right? So from the insurance perspective, and this is illustrative and useful, and we'll get back to this, from the insurance perspective, consider the difference in the experience between the people who sold the insurance in hurricane season, the insurer, and the people who bought the insurance, right? So whereas the insurer, the seller of insurance, lost their shirt during the 3 hurricane season, right? They lost all the profits they made in the last century. The guy who owns the house on the beach, who bought the hurricane insurance when 3 hurricanes came to town, made a killing, right? So, so that's interesting, right? It's interesting that the anti-fragile position and the fragile position are not only 2 sides of the same coin, but in this example, 2 sides of the same transaction, right? So there's a sort of a mythical example of the anti-fragile position, and this is a useful one to know. The myth of Hercules. Remember, the Hercules had his 7 labors or 9 labors, I forget. He had to go kill some stuff, and one of the things that he had to kill was this monster called the Hydra. Right, the Hydra was a snake with, I think, 9 heads, and the deal with the Hydra was that every time you cut off one of its heads, 3 more grew in its place. Right, so I forget how he actually wound up killing the thing, but that's a perfect example of anti-fragility. The more you hurt it, the better it gets, right? So given that we've got these sort of 3 different but related sorts of positions one can be in, let's take a quick detour into finance, and I want to talk about options, okay? So first of all, what's an option? So an option is a financial instrument that I can buy or sell. So it's like a stock in that sense, right? Except that an option is actually a contract. And what an option says is, hey, look, you give me some money, and in return, on a certain day, I'm going to let you buy this thing from me at a certain price, right? And so that's called the strike price, right? So for you, if the price of the thing is less than the strike price, why would you buy it from me at the strike price? That's pointless. You could just go to the market and buy it cheaper. So in that case, the option will expire on that day, and it'll expire worthless, which means that you've basically lost whatever you paid me for that option. On the other hand, let's say that you buy an option from me that gives you the right to buy from me something at, say, a price of $100, but then the market goes up, and it turns out that on the market, that thing is worth $200. Well, that's awesome for you, right? Because you're going to exercise your option and buy that thing from me for $100, and then you can turn right around and sell it on the open market for $200. You're going to make $100, and that's a big win for you, right? Big loss for me, but a big win for you, right? So options have this interesting property, right? Where depending on how you organize them, one side, win or lose, is capped, right? So me, when I'm selling you that option, and this technically would be a short option, it's a short call. When I'm selling you that option, what you pay me for that option, that's all I'm going to make, right? So if you give me $1 for that contract, and I'm going to make $1, and that's it. On the other hand, if you exercise that option, I could lose my shirt, right? Because now I'm selling you stuff at one price when the market value for it, I've got to go out and buy it for 200 and sell it to you for 100. I could lose a lot of money. So the bottom line is that when I sell an in-the-money option and the market moves a small amount either way, I make a little bit of money, right? Because the market has moved up or down, but not enough that you can exercise your option. I'm going to keep what you paid me. You're not going to exercise your option. I'll make a small amount of money. But in a period of high volatility, if the market moves too much in the wrong direction, then I can lose everything, right? So whereas my upside is capped, my downside is unlimited. Now, the only reason I would even make this bet is that I can tolerate a little bit of motion before my downside happens, right? So as long as nothing nothing too crazy happens, as long as volatility stays low, I'm more or less guaranteed to make some money. And what I'm doing is I'm making the assumption that your option is going to expire before anything really bad happens, right? Now that is a fragile position, right? Because in a period of low volatility, I'm good. I'm not going to make much, but I'm going to make something. But in a period of high volatility, I'm hurt, right? So a short option in this case is fragile to volatility. Now, let's compare that with the exact opposite scenario. This is the guy who bought the long option, or who bought the option from me, right? So now this is a long option, and he's got the exact opposite situation, right? So for him, on day one, he's taken a loss. In other words, he paid for the option, right? He paid for the option, but he can't exercise it. So he's lost a little bit of money. And if the market doesn't move much, he's still going to lose some money, but his losses are capped, right? He's never going to lose more than he paid for that option. But if extreme volatility happens, in other words, if the market moves more than a little bit, my loss is his gain. In other words, with a long option, my losses are capped and my gains, my upside, are unlimited. And this, by the way, is exactly how Taleb made his 8 or 9 figure fortune in 1987. This is an anti-fragile position. In other words, it is improved by volatility. Okay, so let's look at these two together. And again, I get that we're using financial instruments here as a metaphor. Okay, so we're going to get back to regular decision making, but I want to kind of get the whole thing out here. So when we look at the top of this thing, that's an anti-fragile position, right? So from wherever I am, if I go to the left, in other words, if the thing that I'm watching, right, the price of a stock, the price of tea in China, the weight of the average dog in the street, if I go to the left, I'm going to experience some pain, but a limited amount. If I go to the right, if things get really crazy, I'm going to make a lot of money. I'm going to do very well. Right? The opposite of that position, in this case, the short option, is the fragile position, and it's got exactly the opposite dynamics. In other words, generally speaking, I'm going to make a little bit of money, but when things go haywire, I'm going to lose a lot, right? So this is interesting because, we saw this already in the example of the insurance company, how you've got this transaction between a buyer and a seller, and one side of the transaction had this was the insurance company, had an intrinsically fragile position, right? They made a little bit of money, but when things blew up, they lost everything. And the other side of the exact same transaction had the exact opposite experience, right? So their experience, whereas the seller of insurance, their experience is fragile, the buyer of insurance, their experience is anti-fragile. Yes, the insurance costs a little bit. Yes, there's a premium. Yes, they may pay for months or years a small premium, but when 3 hurricanes come at once, which happens, they're going to make a lot of money. And if the insurance company is going to lose everything that, all their profits for a century, well, guess what? The guy with the house on the beach, whose house might not even have got destroyed by those 3 hurricanes, he may make back quite a bit more than he lost in the house, right? So fragile and anti-fragile positions, opposite sides of the same coin. So let me stop there for a second, because it's a lot of sort of graphs and stuff. And let's ask Jim McMullen. Is this making sense to you?
I got to be honest, I had to drop off just for a minute, Jason.
Oh, lost you.
I do like the idea. The anti-fragile position sounds really good. So
it's a good place to be. Yeah. The trouble is recognizing that position. And so the key point that I'm trying to make here, and I hope it's coming across, is that there's a certain dynamic. There's a trade-off. We engineers, we're accustomed to trade-offs, right? So there's a trade-off typically between fragile and anti-fragile positions. And the trade-off is this. If you want to make money every month, let's say you own a condo, right? So every month I've got my condo, I'm going to rent my condo, and after I pay my association fees and my taxes and blah, 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 I'm going to have $1.97 left over from my rent, and that's my monthly profit on my condo, right? So I'm making money every month, but it's not a lot, right? On the other hand, the termites and the fire and the flood and the coronavirus all happen at once, right? And when all that happens, I find myself suddenly in a position of extreme loss that completely wipes out all the profits that I made for all those months when I reliably made $1.97 a month net on my rent, right? So that is a typical dynamic of a fragile position, which is that you can make money, and you often will, a little, but when you lose a lot more than you made. The reverse of that is the anti-fragile position. So in an anti-fragile position, you have to become accustomed to regular loss, right? Because an anti-fragile position, it's the exact inverse of a fragile position, right? An anti-fragile position typically involves a small regular loss. And the best way to think about that is paying insurance premiums, right? You pay that premium. Nothing happened, but I keep paying my premium, right? Yet, when the catastrophe happens, you don't lose. Either you don't lose anything when everybody else around you does, or you make a lot of money, right? So you win that bet. So if you think in terms of the apartment, right? So here I have a renter, who is paying a premium to rent his apartment, right? Because he's got to pay your mortgage, and he's got to pay your taxes and your association fee and blah blah blah, and then on top of that, he's got to make it worth your while. So he's got to afford you some sort of a profit. So the apartment renter is making a premium. Is paying a premium for the privilege of insulation against your losses when catastrophe happens. But when catastrophe does happen, what does he do? He packs his shit and he moves across the street, right? So the apartment renter is in a anti-fragile position compared to the guy who owns the apartment, right? Okay, so that's the key dynamic. So let's take that a little farther, and let's talk about this notion of optionality. Now, we've been talking about financial positions, right? And I want to think about the word position in a more general sense. In finance, a position is when I bought some stuff or I sold some stuff, and so here's the package of stuff that I bought and sold, right? That's my position, right? But more generally, a position is where you are, right? It's the circumstance that you've chosen, the bet that you've made, whatever it is, the career path, for example, that you've chosen, right? That you've chosen, based on some expectation for the future, based on, whatever your criteria were. That's your position, right? So in finance, an option, we talked about options, an option works the way it does. It provides that limited downside, unlimited upside, or limited upside, unlimited downside. It provides that dynamic because you literally have options. In other words, the guy who purchased the option has the choice as to whether or not to exercise that option. He's only going to exercise the option if it's profitable for him, right? On the other side of the transaction, you're stuck with it, right? If the market moves against you and the person who you sold the option to exercises it, you're stuck with his choice. You don't have optionality. Only the purchaser of the option does, right? And this is part of the dynamic that we're dealing with here, right? In an optional position, most positions have two sides, and really only one side typically has the option, right? But anyway, so the option in option, financially speaking, is because there is an option. Somebody gets to make a choice, right? And we can also generalize that, right? So if you're in a position, life position, with optionality, what that means is you have choices, right? You could do one thing instead of another thing. It's as if, to Cassandra, to go to your career path example, it's I'll take my dad's, right? So my dad, the career path thing happened, and missile officers are out. Okay, so he went to dive school, right? So that's the exercise of an option, which you have to sort of really torture the metaphor. Who has an option to go to dive school? Well, you have to invest a little bit in terms of your physical conditioning and other things in order to maintain that option, right? And if you haven't, spent the monthly rent in order to put yourself in a position to exercise that option, then it's just not going to be there for you to exercise, right? Bear with me. Okay, so a position with optionality is a position that that has meaningful choices, and by contrast, a position with no optionality just is what it is, right? You are stuck with whatever the dynamics of the situation are, and critical point here, not the dynamics that you calculated, right? In other words, your expectations, your calculation of probabilities based on what you thought Turkey Tom's expectations of what was going to happen in the next 1,000 days do not matter, right? Turkey Tom has no optionality, and when he goes to the chopping block, he still has none, right? So in this case, it's actually the farmer who's got all the optionality, not Turkey Tom. The farmer is in the anti-fragile position to Turkey's fragility, right? So a position that has optionality tends to be the anti-fragile one, right? Because the position with optionality, the one where you've got choices you can make, is the one where you can actually affect the outcome, right? And so this is really key. If I've got optionality, I don't necessarily have to understand the underlying dynamics, right? I don't need to know what's going on. So let's go back to, let me share my screen again. Let's go back to this guy, okay? So if I'm on this graph, right? If I'm on the top one here, right? Where volatility means that I'm moving to the left and right along this line. And what happens to me is my gain or my loss, right? My pain is capped, right? So if I'm in a position that is anti-fragile in this way, then whatever is happening, whatever is producing that volatility is going to drive whether I gain or lose, right? It's going to drive whether I go left or right on here. But how much I gain or lose is more a question of the kind of position that I put myself in to begin with, right? Do I want my losses to be unlimited? Find an anti-fragile position. Do I want my gains to be unlimited? Sorry, just backwards. Do I want my losses to be limited? Find an anti-fragile position. Do I want my gains to be unlimited? Find an anti-fragile position, and then make choices that preserve optionality. Make choices that preserve the anti-fragile nature of that position. Most of the time, I'm going to lose, right? Most of the time, I'm going to wind up paying a little bit to have the options. But once in a while, I'm going to gain extremely. So that's interesting, right? Because what this does is it puts us in a position where it turns out that understanding, like that, gaining that theoretical understanding of what's going to happen, is not necessarily required or even desired. And in fact, is actually really, no kidding, impossible, right? We don't know what's going on. And obviously, to the extent that we can know, sweet, right? But also understanding that in most situations, there are factors that are not only not under our control, but also not open to detection, like Turkey Tom and the farmer. If we understand that that's the case, if we believe that there are things beyond our ability to know, then we can engineer positions that will benefit us no matter what, right? So that's the key to the thinking here. normally when I think about how to make decisions, what am I trying to do? I'm trying to engineer positions that are going to be maximally beneficial, right? Let me figure out how I can best profit from this circumstance that I think I see. And what we see here is perhaps a different way to approach things. Here, what we see is instead asking the question, how can I engineer a position that's going to not hurt me very much when things get bad, but will benefit me extremely when things get, again, let me rephrase. How can I engineer a position that will, in regular times, maybe hurt me a little bit, not very much, but when things go crazy, will benefit me extremely? In other words, how can I maximize my upside while at the same time minimizing my downside, and with a preference in this case on minimizing the downside? Because what we've seen here is a pattern. And the pattern is that when your downside is capped, your upside is not. So even if I can't see exactly what the upside is, if I can't see the exact path that's going to produce the extreme upside, if I believe, and this is a big if, but if I believe that a closely capped downside almost always translates into optionality, which with smart choices later on, when I learn more, can produce an extreme upside, then instead of looking for, hey, what are the big wins? What I'm looking for are, hey, what are the capped losses, right? So that turns a lot of decision-making exactly on its head. Let me give you an example. So a couple of you probably aware, I live in Indonesia, right? And so when coronavirus happened, if you remember back in March, it all came down over a fairly short period of time, right? I think the thing kind of started to hit the news in early March, and by the time people sort of had an idea of what was going on, it was mid-March, and by the end of March, everybody was in lockdown, right? So in mid-March, we were setting up for a 6-month visa here in Indonesia, and we had a couple of weeks. In other words, right around the end of March, we had scheduled a trip to Malaysia to go do a visa run and sort of get our visas organized. So my girlfriend went down to the co-working center on I want to say the 15th of March, and we hadn't really sort of been with a bunch of people for a few days. And she listened to some people talking, and she called me up on the phone and she said, listen, she said, we need to change our plans. We need to change our tickets. We need to buy tickets. We need to go to Malaysia today, because it sounds like things are changing fast, and they may shut down the border. We might be stuck someplace. So I thought about it, and my thinking was this: what's the worst that can happen? In other words, what's the cost of being wrong? If we go to Malaysia now, then I'm out the price of early tickets to Malaysia, and I've lost a couple of weeks of lifetime on my visa. On the other hand, if we delay and it turns out that everything is shut down, then I might be stuck in ways I can't even imagine. Maybe I'm stuck in Indonesia and I don't want to be. Maybe I'm stuck outside of Indonesia and I need to be there where all my stuff is. Who knows what can happen? So I made the decision, all right, I'm going to take a small loss, because the cost here seems to be a lot less than it might be if I made the wrong decision the other way. So what actually happened was we flew to Malaysia. We got our visas we started the process on Monday. We got our visas on Tuesday, flew back Tuesday night. Malaysia closed its borders on Wednesday, and Indonesia closed its borders on Friday, and we've been here ever since, right? So this was a moment where making the calculation of lowest downside paid off big. This was our own personal black swan, and it could have been very different, right? We could have wound up outside of Indonesia a couple of days later with all our shit in Indonesia, and having a completely different experience. So, so this is to me, this is a very interesting, very different decision-making paradigm. I've got lots of choices. What am I looking for in those choices? Am I looking for the most extremely profitable choice, or am I looking for the choice that, number one, produces the lowest downside, number two, preserves as many options to make different choices in the future as possible, right? That I think is the path to anti-fragility. And I strongly recommend that you guys sort of, pick up some of those books and read them and sort of get this idea more firmly embedded in your brain housing groups. But it is most certainly a different way of looking at things than I've looked at them before. And just one I want to open the floor to comments and questions, but one last point. Years ago, I did a lot of investing in options. I was working for a company that did sort of a facility of the options exchange, and everybody was in options, and so was I, right? I wanted to make money, and I wanted to make money on a regular basis. And so in retrospect, from this perspective, I chose positions that were reliably expected to pay a dividend on a regular basis, but every once in a while, I might lose my shirt. And what actually happened was I lost a shitload of money. I lost six figures. I lost basically, everything that I had. And even though I had some wins, I lost way more than I won over that period. Looking at it now, what I realize is that I did the exact opposite of everything that I'm describing here. I was basically short options instead of long options, and it cost me everything. So that's a real life experience that lines up with this. And I want to kind of throw the floor open, guys. Your comments and your questions. We got about 10 minutes left, and I'm curious to hear what you have to say.
Jason, I missed part of that story about your decision of where to stay. Were you saying that your girlfriend was recommending the opposite of what you decided to do?
No, what I said was that she said we need to change our plans and go today, meaning that I had to sort of eat the cost of an extra ticket to Malaysia and the loss of a couple of weeks of lifetime on the visa, the passport visa, right, and that sort of thing, rather than what are the odds that this thing that's in the news is going to translate into a world changer in the next couple of weeks? We're planning to go to Malaysia anyway. This whole thing that we've got to do now, we were going to do that in 2 weeks anyway. So the challenge was that the calculation was, okay, if I'm wrong about, if it turns out that we didn't need to go right away, then I'm out the cost of a $100 ticket and a couple of weeks of visa time. On the other hand, if we're wrong the other way, in other words, if we decide, it's not going to be that bad and we wait, then what? Nobody knows. And now you're stuck in Indonesia in the middle of a pandemic without a visa because it was expiring, and who knows what that looks like? All kinds of unknowns, right? So my point was that by spending a little bit of money, we spared ourselves a great deal of who knows what. Now, who knows what the odds are too? I mean, we could very easily have gone on for a few more weeks before the lockdown happened, or it might never have happened. Who knows? I mean, you don't know prior. You only know after the fact, right? So the decision-making process, and this is, for me, this was, after having sort of been through all this reading for the past year and sort of trying to understand how to apply this decision-making process, it was the first time that I'd done so explicitly. And, in my case, I got lucky, right? But I got lucky. Not getting lucky wouldn't have cost me much, but in my case, getting lucky spared me a great deal of pain, right? And it's the key to optionality, right? It's the key to preserving, to paying a little bit in order to preserve your options in the future. And so, we've certainly tried to make decisions on that basis since then, and generally it's working out fairly well. But you can see the obvious application to investing as well, right? So in terms of investing, and this is something that Taleb discusses, options traders use Black-Scholes, right? In other words, options are priced based on an assumption of normality of the distribution of price movements, right? So that works when you're talking about something that's, a short move, when you're talking about a price that's going to move, 5%, okay? But 10 sigma events don't happen very often, but they happen a lot more than would be the case if they were actually 10 sigma events on a normal distribution, right? So what that means is that there is a mismatch between the theoretical price of an option as calculated by Black-Scholes for a 5-6 sigma move, right? And the frequency with which that thing is actually going to happen. So in practice, what that means is you can pay a couple of pennies for a long option, for a long out of the money option, a month out for a sort of an extreme price. And most of the time you're going to lose those pennies, but when you don't, you're going to make a shitload of money, right? That's Taleb's approach. And generally speaking, that seems to be an approach that works. And it depends on the mismatch between the theory, i.e. the theoretical price, the Black-Scholes model for those extreme events, and reality, which is that those things happen a lot more often than Black-Scholes calculates. And I think I just like went off the deep end in terms of trader talk. Is anybody but Ron still with me here?
Your situation worked out for you though.
It did. It really did. Yeah. We got. I think we were very fortunate. Paul, what do you think? I just saw your face again. Your picture just came back up.
I've been listening. It was it's late here, so it was I was just sitting in a dark room basically. So it was just, it's interesting, the optionality, and I think it's one of the things you're sort of trained to do it, but I've never really put some framework around it in that way, and I've used it frequently without even knowing I was using it.
Of course you have. That's the amazing thing to me, right? No plan of battle survives first contact with the enemy. I mean, how many times have we heard that, right? I mean, this to my mind is a way of thinking that all of us are. I mean, this is our bread and butter. And what Taleb has done is he's put, sort of a formal structure around it, to the extent that there can be one. At the end of that, look, I probably ought to set up some sort of an affiliate account with Amazon, but I don't have one. Go buy Black Swan or Anti-Fragile and see what you think. I think what you're going to find is a set of concepts that are going to resonate very strongly with your own intuition and the sort of the experience that we've all built up, in the Navy, in business, doing real things in the real world. Right. This is going to be a decision-making framework that's going to make a lot of sense to you. Well, look at that. It is 9:29, which is about as perfect timing as we could possibly hope for. I'd love to hear any parting shots. We got a minute or two, and I'm curious to hear what else we have to say.
I was just thinking, Jason, if you felt like you made the right call and your girlfriend was the opposite, just don't remind her of that. That's all.
Also, let's see.
General advice. Yeah.
I bet you there's a way to work that into the optionality frame too, right? There's something about capping your downside.
You have no upside to that, I can assure you.
No upside. Exactly so. All right, guys. Well, thank you for joining me for this. So just real quick to set expectations. These are all very freewheeling, and this is the third time we've done this, right? So never know where these conversations are going to go. This was interesting. We're going to take this and clean it up, eliminate long silences, my coughs and whatnot, and we'll have it up on YouTube here within probably within the next 3 or 4 days. Where you'll be able to see it. I don't expect 1 million people will view it, but it's useful to have the audio and useful to be able to refer back to. Let's see, Paul, I think you've never been to a meetup, right?
First one. Wasn't quite
Outstanding. Okay, so this was a bull session. The meetups are much more sort of social. There are, I don't know, typically 50 or more people on them, and a lot of classmates. What Naval Academy class are you, Paul?
97.
Oh yeah. Who do we just have? Here, bear with me for a second.
I saw Matt Harden on there. Sil was on there.
Yep. Yep.
Buster Joseph.
Yeah, we got a few 90. The funny thing is, I still, did you notice I stole your class ring for a logo?
Oh, I didn't even catch it.
Yeah, it was the best class ring picture I could find on Google. Here, one more moment. 97. Oh yeah, we got a few. Eric Bronner, Janelle Brown, Mike Darcy's around.
I saw Matt Harden there. I knew him from 99. I flew with him.
Tyler Ledoux's around. Tom Strangis shows up. He was just here with us last week. Yes, we got a few of your guys. Anyway, if you come, you'll see. It's sort of part networking event, part class reunion, part mastermind, all fun. So come on, we'd love to have you. And all right, well then, I guess that's it. So thanks everybody for showing up. Great discussion. I hope it was valuable for you. I will put links to the books and whatnot in the YouTube sort of description, so it's all sort of in one place. And I hope you get a chance to pick those books up and enjoy them. They'll definitely change the way you look at the world. So have a great couple of days, and I guess those who show up at the meetup, I'll see you in a couple of days. Take care.
Thanks.